One of the most important pillars of the U.S. economy, of course, is the consumer. And even before last month's UK vote to leave the European Union, there were mixed signals about whether U.S. shoppers are on hold or on solid or shaky ground. Mike Santoli tries to make sense of it all.
The American consumer is the single biggest driver of the world economy. From a broad view, consumer fortunes look bright. Unemployment is low, job openings are at a record high, and wages have been growing faster than inflation for a while now. The housing market continues to rebound. What's more, the average household has borrowing under control. The percentage of income needed to service debts hasn't been lower since the 1980s, thanks to low interest rates and smaller balances. Yet stocks that are closely linked to consumer spending and lending have been conspicuously weak in recent months, a hint that the markets are concerned conditions might worsen from here. Whether retailers, car makers, airlines, or credit card stocks, the shares that should be helped by a flush consumer are having a tough year. This might be because credit card and auto loan delinquencies have turned higher lately, albeit from extremely low levels. This raises early alarms that this consumer credit cycle might be turning for the worse. Now, this might also simply represent an excess of worry by investors who were burned ahead of the last credit crunch. Even after last month's disappointing employment report that showed just 38,000 new jobs added in May, the backdrop for the typical worker seems benign. The bottom line, consumers for now seem to have an ability to spend more, but with financial market turmoil and a contentious campaign season underway, it's unclear if they will choose to open their wallets wider in coming months. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.